Hello and welcome to CNN Vantage Point. I'm Philip Prough, Chief Investment Strategist with CNN Wealth Management. Today's podcast will provide a market review for the month of March of 2026 and our current positioning. March was marked by heightened volatility as geopolitical tensions and economic uncertainty weighed on global markets. The ongoing conflict involving Iran dominated headlines and significantly influenced investor sentiment, particularly through its impact on energy markets. Disruptions to oil supply routes pushed crude prices sharply higher during the month, increasing inflation concerns and contributing to a broad, risk-off tone across markets. Brent crude surged over 40% during the month as its price reached $118 a barrel. U.S. equity markets declined as higher energy costs, rising uncertainty, and renewed inflation fears pressured valuations. Investors rotated away from growth-oriented areas of the market towards more defensive sectors, while technology and consumer-sensitive stocks experienced increased volatility. The S&P 500 ended the month down 5%, but it had declined by nearly 8% during the month. International markets also moved lower, reflecting similar concerns tied to geopolitical risk and commodity prices. In fixed income markets, Treasury yields moved higher overall during March, as investors reassessed inflation risks stemming from elevated oil prices. The 10-year Treasury yield rose from 4% to 4.3% during the month, and the closely watched 30-year fixed mortgage rate increased from 6% to 6.5%. Despite this upward pressure on yields, the Federal Reserve held interest rates steady, reiterating its commitment to a patient, data-dependent approach. Fed officials emphasized that while inflation has moderated from prior peaks, uncertainty tied to global developments continues to warrant caution. Overall, March underscored how quickly external events can reshape market expectations. The equity markets appear to be pricing a short conflict in the Middle East. Even if hostilities are short-lived, we think the ramifications to the oil markets and its supply chain will be longer lasting. This may place a new floor on oil as well as a trickle-down effect on goods pricing and inflation. With the U.S. economy already slowing going into 2026, odds of a stagflation environment have risen. This environment has played out in the bond market as yields increased during March. The Federal Reserve maintained its Fed funds rate, and the futures market is projecting no rate cuts in 2026. That's down from a projected 2 cuts at the start of this year. With risk increasing over the past month, we're repositioning our portfolios from slightly overweight to risk assets to neutral. Within equities, we'll move up the market capitalization stack by adding the large cap and trimming mid and small cap. We'll keep our value tilt. Within fixed income, we'll add to tips, but we're retaining our ultra short position to remain patient for better opportunities, both within fixed income and equities. We'd like to remind our listeners that market conditions can change quickly. As circumstances and facts change, CNN's market views and portfolio positioning may change accordingly. If you'd like more information about our current positioning and market thoughts, please contact any of our wealth management advisors. On behalf of the entire CNN Wealth Management team, we thank you for listening.
Please note, views are subject to change based on market conditions and other factors. These views should not be construed as recommendation for any specific security or sector. Client portfolios may or may not be at the positionings discussed due to, but not limited to, distributions, tax management limitations, systematic purchases, etc. Some products are not FDIC insured or guaranteed, not a deposit or other obligation of the bank, not guaranteed by the bank, and are subject to investment risk, including the possible loss of principal amount invested, and are not insured by any other federal government agency.